Good morning. Welcome back to the Broadcast Retirement Network. This is BRN AM for Wednesday, February 21st, 2024. And our top story today, U.S. public pension funds are highly vulnerable to market corrections. Joining me now to discuss this and a lot more, Douglas Offerman is with Fitch Ratings. Doug, it's always great to see you. Thanks so much for joining us on the program this morning.
Happy New Year to you too. It's great to be here.
Yep, absolutely. And Doug, thoughtful piece put out by the folks at Fitch Ratings. We're going to get into that in a few minutes about public pension plans. Always a hot topic to talk about. But I want to get your general sense, just in doing this analysis, doing this research, what's the state in general of our public pensions, both local, state, federal, or not federal, but local, state?
So local and state plans have been doing pretty well in recent years. Investments have been quite volatile, but in 2021, public plans saw a huge run up in the asset values following the pandemic, following that initial market meltdown in the pandemic. And plans in 2023 are seeing some plans are doing quite well, depending on their year end. Those plans that will report results for December 2023 will do as well as the markets have done, with significant upticks in valuations. But it's been a volatile couple of years for everybody on the market, and that's why we wrote the piece.
And as a follow-up to that, let's talk about some of the vulnerabilities. And one of the piece really hits on market correction. And, the R word, I will just leave it at the R word, that there potentially could be a recession. There may be some adjustments in the market. Who knows when that will happen? But does that make public pensions vulnerable and any more vulnerable to their brethren or their cousins in endowments and foundations and other big asset pools?
I think public pensions are big market participants, and so they're going to be exposed to the movements in the market that all of those actors are, the endowments, the 401k plans that private sector workers have. They're going to see the ups and downs, but the implications for public pensions are meaningful for the budgets of state and local governments. So to the extent that public plans show weakness in a downturn, the governments that employ those workers are going to need to increase contributions. And that's one of the things we wanted to highlight.
Yeah, really important. Sorry, I didn't mean to jump on you, but that's really important to understand. How does this, a lot of us are familiar with Fitch Ratings because there are some other rating agencies in the United States, but you rate the creditworthiness of an entity. It could be a corporate entity, it could be a public sector entity. How does that pension interrelate to the rating of a sovereign, or what do you call it? I don't know what the technical term is, but of a state.
So we incorporate pension information into every one of our state and local government rating analyses. And we look at unfunded pensions as essentially being the equivalent of debt. They're long-term obligations of governments for their own workers, for their own retirees, and they will have to be paid using the cash resources of the government over time. Most governments have decided over the course of decades to essentially build up savings accounts in trust funds to support those retirees once they reach retirement age. But many of them have large unfunded liabilities in these pension plans, and that poses risks for the government. So we track the unfunded liabilities, and we also track what they have to pay annually to reduce those liabilities. And in some cases, it's a big number. So,
yeah, big number, and ultimately the bill has to be. I mean, you have to pay that. That's a liability. That means you have to pay that benefit. It's not like you can just say, "Hey, Mr. and Ms. Retiree, sorry, no money there." It has to be paid.
That's right. We essentially view a retirement obligation as something that is the equivalent of debt, the same debt that's used to build roads and schools and bridges.
Doug, I need to take a very quick break. When we come back, we'll talk more about the market correction or potential market correction and the impact of public pensions, you're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. We're joined this morning by Douglas Offerman of Fitch Ratings. Doug, thanks as always for staying with us for segment 2.
I'm glad to be here.
And you talked about the report, and there are states on different fiscal years. Some end the calendar year, some do 7/1 to 6/30. It's all over the place. I did want to ask you, there's a trend, I don't know, I'll call it a trend, but maybe it's not a trend. I want to get your perspective on this. There are some states, Alaska comes to mind, where they had closed the DB pension, but now the state legislature, the state senate, and the executive are contemplating reopening the defined benefit plan. First, is that a trend that you're seeing around with other plans in the union? And second, what's the implications to your report? What does that mean?
Well, it's really a policy question for states individually. We'll take it into account if Alaska actually decides to make a change. But it's important to think about pensions as being part of the compensation package of a public sector worker. That's true in Alaska, just like it is everywhere. And when a prospective employee is thinking about working for one employer versus another, one of the things they're going to take into consideration is what they may get in retirement. So it's definitely something that we think about, particularly if you make a change as dramatic as the one that has come up in Alaska. But as a practical matter, very few plans have revisited reduced or reduced benefits or plan closures that have been put in place really since the global financial crisis. In general, benefits for public pension workers nationally have been relatively stable. A few plans have closed. Alaska's closed in 2006, but very few have upped benefits since then.
Yeah, and you bring up a really good point, and I just want to hit on it a little bit more, if you don't mind. When you're an employee, and today is a very hyper, with 3% unemployment, it's a very hyper competitive marketplace. That pension, so I'm thinking about police, firefighter, emergency personnel in particular, we need that. They're on the front lines each and every day at these state and local governments. They have a shorter time frame to work because it's kind of hard to be a police officer. I guess you could do administrative duty, but it's hard to be on the street at age 65. Nothing against 65-year-olds. I'm close. Not that close, but I'm close, closer to that than I am to being a 35-year-old. But that benefit is very attractive, and I wonder if these state legislatures are saying, oh, shoot, it's difficult to compete with state XYZ to get police officers and firefighters, knowing that this state has a DB plan, this one does not.
It's certainly something that legislatures have to consider. the public workforce among state and local governments is kind of aging, just like our national demographics overall. And you need to have an inflow of new workers to take the positions that are vacated by retiring workers or workers moving out of your workforce. And that's particularly true for public safety, where legislatures have certainly prioritized maintaining robust numbers of employees to cover the needs that we have.
Yeah, just to kind of tie off, I want to go back to I know I kind of drifted away. This is how I think. I'm all over the place sometimes, but I want to come back to the report, the potential for a market correction. How do interest rates factor into that equation? Because we talked earlier in segment one about a potential R word, a recession, the impact there, the volatility. But let's talk about the Fed, what they do. What's the implication there if the Fed raises or cuts rates? How does that kind of play into your team's analysis?
Well, it certainly is part of the background of the economy that markets react to, that markets rise and fall with. I'm not a sovereign analyst, and I'm certainly not a Fed watcher, but it's pretty critical for the functioning of the economy over time. Fitch is not, and I should be very clear on this, Fitch is not projecting a big market downturn. That's important to recognize in terms of the message of our piece. But what we are saying is, should there be a big market downturn, pensions are still vulnerable to large increases in contribution. And bear in mind, they've already seen big increases over the last 15 years because of the aging workforce, because of the market losses back in the global financial crisis. And that's critical to think about for local governments that have much narrower budgets and actually employ a lot of the workers. It becomes pretty costly if you're covering your current workforce and having to cover retirees, because benefits or rather investments were not sufficiently accumulated historically. So it's a big deal.
It is, and it's something that if you're a chief investment officer and an investment team of one of these states or local governments, there's a lot to think about. Your piece included. How do you weigh all that? It's a tough job. It's definitely a tough job. Doug, we're going to have to leave it there. Great to talk to you as always. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Thank you very much, Jeff. I really appreciate it.
And that wraps up this episode of BRNAM. Have a topic of interest, somebody you think we should talk to? Drop us a line, and don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, then visit our website. We're back again tomorrow with another edition of BRNAM. We'll have a very special guest, as we always do, and an important topic. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.